Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you a trade setup on Microsoft. It's a directional trade, but for the trade structure, we used an income calendar spread. So the income calendar spread, I'm going to first go through the kind of the basics of it, is a option strategy where it captures time decay without completely sacrificing directional speculation if you set it up correctly. So let's take a look at the basics of it first, and then I'll show you the trade setup on Microsoft. So the basics of the income calendar spread, it's really kind of a neutral option strategy that profits when the underlying stock or security you're trading remains stagnant or trades within a kind of a tight range. So the profit primarily comes from the difference in the rate of premium decay and also the difference in implied volatility skew between the near-term short option and the long-term option of the spread. So this is basically possible because the near-term option premiums decay faster than the long-term option premiums. So it's a really favorite strategy that we use for market conditions when you want to look to keep a long-term position for a particular stock or even ETF when you're expecting a potential breakout to the upside or downside in the future. But what it does, it allows you to enter in and position into a trade for that longer term direction on your speculation, but you're going to be positioned in it and getting paid while you wait for that directional kick in based on this theta decay and implied volatility. So let's take a look at this current trade setup on Microsoft. So this trade setup was today on the 16th of December. And looking here though, we got into this trade when Microsoft was actually trading at 217. But I wanted to show you part of the basics of the trade. So we're playing theta decay. So if you look at the theta here, and we did a calendar, the 220. So what we did was we bought 15 January option series, 30 days from expiration. We went long the 220 call here, and then we sold the closer in 18 December, 2 days to expiration, the 220 there. Now the reason this trade was structured like this is because if you look at theta decay here, you can see this has 27 cents a day theta decay versus the longer dated option, which has 30 days expiration, has $11. So we're playing that theta differential of about $16. So it's a positive theta trade, and you can also take advantage of implied volatility when we have what we call horizontal positive skew. But the trade setup that I liked about this is the other part of this is direction. So let's take a look and review the charts, and then I'll show you the structure. So first off, the Microsoft's been trading in a really consolidation phase here basically since about the November the 10th. You can see it came down here. It's just been in a tight range here for over a month. All right. And this is also what we call a volatility squeeze. So very, very tight consolidation range. And then today we got a breakout signal using our trading model. So the different rules we look at, but basically when it started breaking this 382 retracement here, this is when we went long and the trade set up. By the time we got into the trade, it was trading about 1735. So with this trade, what I was looking at originally was the makeup of the trade was, if you look here, we were looking at this break coming in here to this 382, and then I was looking for the first target up here to about 220. So I didn't really think it was going to explode and get to 220 today. So we did this as a calendar where we are long that option back in the 15 Jan series, 30 days from expiration, and then we shorted this week the 18D, which expires Friday, to take advantage of that theta decay. And so we put this on as a spread, but what we're looking probably to do is position this trade to take off the short trade, the short option, and stay long and roll it and play the upside move and get paid while we wait. So potentially good upside here. The first kind of next resistance point will be here. That's 220. That's what we did our target with the short strike, and that's a 618 retracement. And then we'll be looking up here to 223, 225, and probably back to that prior high. So this is a way to position to get into this potential longer term move. So set this up this morning on this was Wednesday the 16th of December. So bought the 15 January 220 call, and at the same time sold the 18 December 220 against it, and did this as a spread. It's $475 or $475 per spread. Debit paid, that's your maximum risk. And then this thing exploded and pushed up here with a high today close to that 220 strike, and was up over $5.35 or up $58 per spread on this trade just for one day only. So this was up about 12%. But the bigger potential for this trade is to look to close the 18 December this Friday and keep long or stay long that 220 for a bigger move up. So what we were initially hoping for is that actually that it wouldn't close, that it won't close at 220, it'll close below, and we keep the premium, and then we can roll it to the next option series, which will be the 24 December. So let's take a look. So the components of the trade structure is we're long the 15 January. So today that was bought at $5.55, and at the same time as the spread, we sold the 18 December and it was at 80 cents. Okay, so that puts this spread in at 4.75. Okay, so what we're looking to do, what we're hoping for, is that this Friday, the 18th, Microsoft will close below the 220 strike. We actually don't want it to go to 220 or through it, because if it does close below 220, we'll keep the $80 credit here. That will then adjust down or lower the cost of the long dated 15 January by the profit brought in from that 80. So if that was the case, we would now have a reduced trade. It would be now adjusted down to the cost of 470 right here. Okay, 470 if we get to keep that 80. And then what we'll do is we'll turn around and probably sell like the 24 December, maybe the 225 call, widening the spread, and then we'd have what we call a calendar diagonal, and we keep doing that. We keep rolling it for each series all the way to that January 15th, and we could initially potentially adjust the trade down to almost zero cost. So it's a great structure for positioning yourself into a trade for a bigger move and taking advantage of theta decay and implied volatility. So if you like this kind of structure and like to learn more about different option spreads, make sure to check us out and join us at powercycletrading.com. Good luck trading.